దూర విద్యా విధానంలో డాక్టర్ బిఆర్ అంబేద్కర్ ఓపెన్ యూనివర్సిటీ దేశంలోనే మొట్టమొదటి సార్వత్రిక విశ్వవిద్యాలయం. దాదాపు 2.5 దశాబ్దాలుగా దూర విద్యా విధానం ద్వారా కంప్యూటర్ కోర్సును అనుసంధానం చేస్తూ బీఏ, బీకామ్, బీఎస్సీ డిగ్రీ కోర్సులను అందిస్తోంది. పోస్ట్ గ్రాడ్యుయేషన్ స్థాయి, డిగ్రీ, డిప్లొమా స్థాయి కోర్సులను ఔత్సాహికులైన విద్యార్థులకు అందిస్తోంది. డెవలప్మెంట్ స్టడీస్లో సెంటర్ ఫర్ ఎకనామిక్స్ అండ్ సోషల్ స్టడీస్ ద్వారా ఎంఫిల్, పీహెచ్డీతో పాటు విశ్వవిద్యాలయమే స్వయంగా దూర విద్యా విధాన అంశంపైన పీహెచ్డీ వంటి పరిశోధన కోర్సులు ప్రవేశపెట్టింది. రాష్ట్ర వ్యాప్తంగా సుమారు 4.5 లక్షల మంది విద్యార్థులు ఈ విశ్వవిద్యాలయం నుంచి ఉన్నత విద్యావకాశాలు పొందుతున్నారు. డాక్టర్ బిఆర్ అంబేద్కర్ సార్వత్రిక విశ్వవిద్యాలయం స్థానికంగా స్వయం బోధనా పద్ధతిలో ముద్రణ రూపంలో రూపొందించిన కోర్స్ మెటీరియల్ అందిస్తోంది. కోర్స్ మెటీరియల్ అధ్యయనానికి సహకరించే విధంగా రేడియో, టెలివిజన్ పాఠ్యాంశాల ఆధారంగా కార్యక్రమాలు ప్రసారం చేస్తోంది. అధ్యయన కేంద్రాల ద్వారా ఏర్పాటు చేసే సలహా సంసర్గ తరగతులు, సైన్స్ ప్రాక్టికల్ సౌకర్యాలు విద్యార్థులకు స్వయం అధ్యయనానికి ఒక చక్కటి అవకాశం. ఇవి విద్యార్థి సమీపంలో ఉండే అధ్యయన కేంద్రం నుంచే పొందొచ్చు.
Good afternoon and welcome to all the viewers of the teleconference programs of Dr. B.R. Ambedkar Open University on the topic Transfer Pricing, a program meant for MBA third-year students under Management Control Systems. You are aware that finance is like any other field an ocean. Some concepts in it are common, they sound next to door because we use them in our daily activities, whereas some concepts are uncommon. In fact, the topic that we're going to deal today is one of its kind. It is more specific and deeper into the area of finance. The topic that we're going to deal today is transfer pricing. So, in this connection, I solicit your active participation in discussions and seek clarification from the resource persons who are present here. You may allow 30 minutes for subject presentations, and thereafter you can seek clarifications if any. For reaching us, dial 040-270-314-3132-33. A guru is one who unwirls critical things and makes them simple. We are fortunate to have amongst us two commendable gurus who are not only extraordinary preachers but also successful practitioners. Before we go into the discussions, let me take the privilege and honor to introduce our eminent professors to you. To my left is Professor K. Swamigaru, Dean, Faculty of Commerce, Dr. B.R. Ambedkar Open University. If discipline, hard work, and dedication are prerequisites for success, then he is a symbol of all these traits, with an additional feature of honesty and sincerity, which is a rare quality in this materialistic world. Thank you, sir.
Thank you.
To my extreme left is Professor K. Mishra Garu, Director, Institute of Public Enterprises, a visionary, a man who can convert words into action and lead them to success, a symbol for a perfect academician, a teacher, researcher, consultant, entrepreneur, and a turnaround specialist. He is a very popular and familiar personality in both academics as well as industry in the management circles. It is our fortune that a jewel and its crown is amongst us. Thank you, sir.
Thank you.
Now we shall start the discussions. Sir Swami sir, we would like to know what is transfer pricing?
Thank you. Before going to the subject, let me tell you very briefly about management control systems. The objective of any management control system is to divide the organization into a smallest unit I mean, you will come across very big organizations, large in size in terms of number, output, departments, products, so on and so forth. So, as a management specialist, what we do is we divide the whole organization into a smallest unit where we can identify by product or by service or by geographical nature, whatever it may be. We are trying to divide into a smallest unit, identifiable, and assigning to a person who will be held responsible or accountable for the performance or otherwise of the business unit. It is nothing but a kind of decentralization. So, what we are trying to do is where we are adopting, we are resulting for decentralization. We are identifying a unit, allowing the person to take the decisions and making him accountable or answerable. That is the basic objective of management control system. When we talk about transfer pricing, it is really a specific one. When the size of the organization grows big in size, more in number of departments, and at times the output of one unit will become input for other unit. So, as a management specialist, we are identifying each and every activity in the organization, making a person responsible. We are treating that center or a unit as a center for either profit making or for earning ROI, whatever you call. Normally, when I talk about the responsibility centers, you will have expense center, revenue center, profit center, and ROI. So, here the idea is you are treating every unit as individual, autonomous, independent, and making him accountable. Now, the question is, when the output of one product, one unit is going to become input for another unit, how it has to be priced. Now, it is very clear that within the organization we have separate departments. Probably you may call it process costing. You take oil field industry, crude oil is processed, is it not? So, likewise the output of one unit will become input for other unit. We have to price it. So, you are very clear that every unit is expected to make profit. I mean, every center is expected to report to the management, earn profit or create surplus. So, transfer pricing is, it is nothing but it is a transfer of output to other unit as an input. It is only transfer, it is not sale. Let me make it very clear, it is not a sale. So, the price has to be fixed, the transfer price. The moment you transfer your output to other unit, that has to be priced, because you are expected to show the performance to the management. You are accountable for the activities that are being carried out by you in your own unit. You are answerable to the management. So, naturally, the price, the transfer price must be what you call it is competitive, very competitive. It cannot be simply passed on the inefficiency to other organization. So, it is a notional price. Transfer price is nothing but it is a notional price. Automatically, it is going to affect on the performance of the unit, performance of the organization. What we are doing here is we are pricing for the inputs of physical goods and services, that is you are passing on to the other institution. So, all these things have to be kept in mind while fixing the transfer price. So, the transfer price should be very compatible. It must be fixed in such a way it will not hamper the interest of any one of the units. That is about transfer pricing. Here we can conclude that the semi finished product, whenever it passed on from one unit to other unit, it is called transfer pricing. So, it is a notional price, in fact it is a notional price. So, normally what we do is we take into account the total cost whatever we have incurred, probably actuals, then we add a percentage of profit and fix the transfer price. So, whenever you fix the transfer price, you have to keep in mind the efficiency of the organization. Suppose if you are carrying inefficiently, ineffectively, by incurring higher cost, automatically what you are doing is you are transferring the inefficiency to the other organization. Since all these units are part of the organization, all these units are independent units working in the same organization for the working for the realization of the common goal. So, the efficiency, in case if you operate effectively, efficiently, definitely you are going to your performance is going to be good. So, since every unit is part of the organization, when all the units within the organization work effectively, the overall performance of the organization will be more effective. So, the price, it must be as practical, as possible to the ground realities. That is about transfer pricing.
Thank you so much, sir. We had a very elaborate introduction to transfer pricing given by you, which has cleared some of the confusion that we had about it. Sir, Mishra sir, can we ask you why transfer pricing?
I think partly it has been answered by Swami sir, but I think there may be 2 or 3 reasons. One is we require transfer pricing, as Swami was mentioning, for the efficient use and a good allocation of the resources. Resources are very limited. There are different departments, there are different divisions. How should they be using it? So, transfer pricing helps us in ensuring that various departments of a company, they use the resources efficiently. That is one. Number 2, transfer pricing is very essential for goal congruence. As Swami was mentioning, you have large enterprises which have different divisions and departments. Now, all these divisions and departments, they like to earn profits. But as he was telling, the output of one division is the input for the other division. Therefore, what happens is that pricing becomes an issue where different departments, they come and they take the battle on their hand. On the other words, in the other way, we can say that pricing becomes the battleground for different departments in an enterprise. Now, how we can solve this problem? This problem can be solved by introducing the concept of transfer pricing, where we may have a formula or we may have an approach which can take care of the concerns of the various divisions of an enterprise. The third thing I think which is very important is to ensure that the resources in an enterprise, they are very productively used. And again, I think to see that they are very productively used, again I think you require transfer pricing for that purpose.
Thank you so much, sir. Swami sir, can you explain us the implications of transfer pricing and corporate policies?
Okay, when we talk about corporate policy, As you are all aware, policies are made by the management. They have to be necessarily followed by all the units working within the organization. Some policies may favor some of the units, some policies may not favor some of the units. Some policies may be profitable to some of the units, may not be profitable to some of the units. But on the whole, in order to have effective transfer pricing, probably we have to look at three important aspects. Number one is divisional autonomy. Number two is transfer pricing. Number three is performance evaluation. Under management control system, what we are doing is we are giving autonomy to the individual heads to run the organization and move in the direction of profit making or in the direction of earning ROI. That is what we are doing. So, you are giving autonomy in the sense divisional autonomy. The old division will be treated as an independent unit and is answerable for all the activities to the top management. That is very, very important in case of implementing or having effective transfer pricing. Number two is transfer pricing. So, the output of one unit is transferred to another unit. To the extent possible, it must be as equitable as possible, because all the units working in the organization are part of the unit, so that every unit is expected to earn profit. Every manager of the individual units will be held accountable. They are answerable for the performance. In the sense, what we are doing is the works done by or the performance of every individual unit is going to be measured in that context. In that context, the transfer price must be as equitable as possible. The third important thing is performance evaluation. Here, suppose let me cite there are 10 units working in the same organization for the common goal of the top management. Unless each unit work effectively, the overall performance cannot be effective. If there is any inefficient unit, definitely it is going to affect the overall performance of the organization. These three are very important. When we talk about divisional autonomy, in the case of divisional autonomy, what we do is we are setting the standards to measure the performance of every unit before creating a responsibility center. We set a standard, we set the guidelines, we set how they are expected to report, number one. Number two, how their performance is going to be measured. All these things are preset and unit is created and a person is made answerable or accountable. So, what happens here is every individual unit manager is expected to report to the management. It is nothing but a kind of accounting process. So, the management will develop a accounting procedure. That is number one. They submit a detailed accounting report to the management, wherein the management can measure the efficiency or otherwise or the performance of the organization. Number two is accountability for the decisions or actions that are taken at the level of the individual unit. So, here top management is giving power to you. The top management is giving power to you. So, when you are sanctioned power, you have authority to extract the work, you have authority to delegate your power to your lower level staff, but accountability remains same. You cannot escape from the accountability. Though you are delegating your authority to your lower level people, still you remain answerable to the top management for the decisions taken or for the actions at your unit level. That is also very important when we talk about the transfer pricing. The third important aspect is quite oftenly, though the fact is that the managers of all the units are expected to act autonomously, independently, take their own decisions, there will be a possibility of management to interfere. So, we have to ascertain what will be the frequency of interference of the management in the affairs of your activities, because your performance is going to be affected by the interference of the management. Definitely the management will have one thing in their mind and you have something else in your mind. So, since top management, since the central management, if they interfere, naturally your performance is going to be affected. So, here all these things will come into the picture, or all these things must be examined before going for the transfer pricing. Now, one more thing we have to keep in mind here is, when you are creating a center, when you are transferring the output to other unit, then you must be cautious to see that a kind of balance is striked off. A balance is striked off between all the units. Neither you have to favor one unit nor disfavor other unit. You have to allow them to work independently, autonomously. Then only you will be able to make them answerable or accountable. Otherwise, definitely the performance of every unit is going to be affected. So, to the extent possible, what we advocate is, let the unit act very independently. At the end of the year, you measure the performance and you make them answerable or accountable. So, all these things have to be kept in mind and design the corporate policies to allow individual units to work effectively for the common goal of the organization. That is how corporate policies will affect the transfer pricing methods.
Wonderful. So that was a very detailed explanation about the implication of corporate policies on transfer pricing, sir. We have alleviated our knowledge to that extent. Mishra sir, would you highlight the global practices on transfer pricing? The global practices and their implication on transfer pricing.
See, the global practices which are being followed are very simple. Again, as Professor Swami was suggesting, global practices come mostly, from the cost accounting methods. He talked of process costing, he talked of job costing, and we see in the case of process costing, there are different processes. And when you move from one process to another process, the question of costing comes. Now, what happens is that when you talk of these international firms, global firms, you see that they produce different things at different locations. But the question there comes that how they should be pricing the products, how these units should be pricing the products. As Professor Swami was suggesting, the whole idea behind a global firm is to give adequate autonomy to its different components. But at the same time, they all have to work for the goal of the corporation. Now, keeping that in mind, number of surveys have been conducted, and those surveys, they point out that there are a few practices which have been having acceptance all over the world. You talk of what is known as cost based prices. In the case of cost based prices, what you do is that you take different kind of costs. For instance, we talk of absorption costing. Now, in the case of absorption costing, whatever costs we have incurred, all those costs are put together, and then the products of one division, they are passed on to other division. But the problem here is that in the case of absorption costing, there is no incentive for the producing division to economize on different costs of production. What they do is that they keep on incurring any amount of cost. They know that these costs can be passed on to the other division, and therefore they don't make any effort to innovate new kind of production processes, new kind of production technologies. Therefore, what happens is that in some cases we talk of standard costs, and we work out the standard cost, and these standard costs they are worked out, and based on that the input price for the other division that is decided. Then we have another method which is known as market based costing. In the case of market based costing, what happens is that we see the market prices, and whatever are the market prices, they are the prices that division, which is the input division, that input division will have to accept. Then I think the third kind of pricing method that we have found everywhere in the world is negotiated prices. In the case of negotiated prices, what happens is that the input division, which passes on its product and services, they negotiate the prices with the other division. We also have what is known as linear cost pricing methods, where we take the objectives, maximization objectives of profits, minimization of the costs, and we work out the prices. This is, I think, somewhat a tough kind of method, which is rarely followed, I think, in different parts of the world. And then we have another method which is known as specialized specialized transfer pricing method, where what we do is that there is some special product, and on this special product again a sort of discussion takes place, and then finally the prices are decided. But world over, we find that these market based prices, they are the prices which are most acceptable prices. They don't put any input division at disadvantage. At the same time, they also facilitate the transaction between one division to another division.
Excellent, sir. We have elevated our knowledge to the level of the global practices relating to transfer pricing through your explanation, sir. And when in practice, we have come across different transfer pricing methods like market price, adjusted market price, manufacturing cost, negotiated cost, opportunity cost, etc. Now let us elicit the details of each of these methods. Swami sir, could you highlight on what is market price?
When we talk about the market price, as Professor Misra already explained very briefly, market price is that the goods or services that are available in the open market at a particular rate, that is called market price. Anything you take, the market price is determined by interaction of demand and supply. In fact, we presume that we are all operating in a perfect competition. When you critically think about it, there is no more perfect competition. In fact, under perfect competition, the prices are going to be uniform for all the similar products. Do we have the same price for all similar products? No, definitely. They are not charging the same price. What is happening then? Different people are fixing different prices for their products. Though we are operating the perfect competition, perfect market, what makes the difference? Probably quality, grading, support services, after sale, all these things definitely are going to influence the perfect competition prices. But when we talk about market price, the assumption is that we are operating in a perfect competition. With that assumption we are proceeding. So it's nothing but the rate at which your output can be sold in the market. So it's nothing but a kind of ceiling on the price. So market price is the maximum price at which you can sell your product. It represents the ceiling. It is the maximum that you can sell in the market. The price that is already available, that is available in the market for sale. These are all referring market price. So here, whenever you are transferring, you are proposing to transfer your output to other input, it must be taken as the basis. Whatever the price it fetches in the market, that must be taken as the transfer price. Forget about all other costs, whatever you incur in the factory. You are not expected to take them into account. You have to go by only the price where your product or services can be sold in the market. That is market price. But the constraint on our part is all these two units are operating independently as an integral parts of the organization. Now, suppose in case the output of one unit is underpriced, presume that in the market it is available at lower than what you are proposing to transfer to other unit. Are you going to buy from outside? If you are going to buy from outside, automatically what is going to happen? You have to close down the other unit. So it is a constraint. When we fix the transfer price, it is going to be a constraint. We are not here to close down other unit. We are not here to, at the most what you can do is you can take the market price is the basis as the basis for your transfer price. When you take the market price as the basis for transfer price, your actual cost may be lower than that. In case your actual cost is lower than that, it is fine. In case your actual cost is higher than market price, what will be your fate? What will be your performance? How are you going to be treated by your top management? How are you going to report to the top management? How is your performance is going to be measured? So how it will have effect on the overall performance of the organization? All these things have to be taken into account while looking at the market price. But on the whole, we can say that market price is the best price. It is a competitive and compatible price. Okay, when there are other sellers, when there are other units are ready to sell their product at a particular rate, why you are not able to sell at the same price? So if you are not able to sell at the same price, definitely probably it will be your inefficiency, whatever is the reason. But it is going to be a correct yardstick for fixing the market price as the transfer price. Normally when you look at any product, the price of different products, the price of similar products will be nearer. There will not be much variation. They will be nearer. Probably marginal difference will be there. Because as already I have mentioned that some people are having quality consciousness, great, they render better services, they will come to the rescue of the buyers. All these things will make to fix little bit differently or little bit highly. But normally what happens is market price will be the better price for transfer pricing. Under certain circumstances, there will be deviations from market price. There will be. For example, let us take a firm is going to undertake its manufacturing process in view of the economies of scale. If you undertake a large scale manufacturing process, definitely you are going to fix you are going to produce at economical rate, you can fix lower rate, and definitely others will not be able to compete with you. It is exceptional case. Similarly, sometimes you wanted to low preference to high preference. So definitely under those circumstances also the prices are likely to be variable. Also, we have to keep in mind the tax considerations. Is there any tax incentive from the government? It will affect a lot in fixing the price. So under these circumstances, there will be a deviation from the market price. But on the whole, we can conclude that market price is the better judgment for fixing the transfer price. Now we are talking about transfer pricing, market price as the transfer pricing. As already I have mentioned that the individual units are working for the realization of the common goal in an organization. So what happens is interdivisional transfer, definitely interdivisional transfers. We have already used a word. Every unit will be treated as a division. Every unit will be made accountable or answerable for calculating or for producing the desired ROI. Is it not? So when integrated individual units, divisional units are striving for the common goal, it is not possible to adopt market pricing, since as already I have mentioned, if the market price is lower than our product, we cannot go to the market price. We cannot buy it from the open market. Though we will take it as a basis, market price will be taken as a basis, but we cannot resort to purchase from outside, because there is another unit where your output is going to be input for that unit. So these are all implications or constraints in case whatever adjustment is expected to make under this internal transfer, that is called adjusted market price. That is about market price or adjusted market price.
Very good, sir. I think those clouds of transfer pricing are slowly unwurling as we are alleviating our knowledge level by level. Mishra sir, will you explain us the role of manufacturing cost in transfer pricing?
Thank you. See, when we talk of manufacturing costs, again, different surveys, they point out that raw materials cost, the cost of stores and spares are about roughly 45 to 50%. Labor cost is around 25%. If they are labor intensive, enterprises, about 25%. But suppose you talk of an automobile, manufacturing company, it may be about 5%. Then you have, charges, energy charges. Energy charges are about 10 to 15%. And you also have interest cost, which is about 10 to 15%. So these are, major component of the cost. Now, how do you deal with them? What do you do about them, which can bring down the costs? And you find that, it is possible, I think, to reduce the manufacturing cost through innovations, through introducing different kind of processes, through good R&D. And one good example of that, you can see, how automobile industry, it shifted from US and it came to Japan. Now Japan did a lot of R&D in that. Japan substituted different kind of parts. And we are seeing that, again, I think, the car industry, automobile industry is shifting from Japan, it's coming down to India. Maybe, I think, because of some other considerations. Likewise, energy costs are very, very important costs, and we are seeing now different kind of R&D is being done, and energy costs, they are being brought down. We talked of absorption costing, and there we talked of, full costing. And Swami was also talking of variable costs and fixed costs. Now, when you talk of, the transfer pricing, you see that manufacturing costs are more or less fixed costs. And therefore, I think if we can bring down these costs, then that will help us, in improving the profits of the enterprise. And therefore, I think you'll find that everywhere. I think all over the world, the effort is being done. I think in the input divisions, which are producing things for the other divisions. We try to introduce standard costs. We ask them to do more and more R&D. We ask them to change processes, and all these, I think, put together, they help in bringing down the costs, which can help which can help them in improving their profits, which can also help them in improving the profits of the other divisions. It is very, very important, because you can understand that problem of transfer pricing is not only the problem of pricing goods from one division to another division, but it also helps us, helps the division in projecting how much profit it has earned. If they are able to show more profits, they will get more bonuses, they will get higher salaries, they will get higher incentives. And therefore, what happens is that there is a pressure in transfer pricing on all the divisions to do something which can help them in reducing their manufacturing costs and thereby increasing profits, which can help people at the top, as Swami was telling, top managers, also people at the middle level, also people working on the shop floor. And therefore, I think controlling the manufacturing cost is a very, very important component of transfer pricing.
Let me supplement, sir. I have few things to add to Professor Misraji. Number one, when we talk about cost, we have standard cost. You may ask me, what is standard cost? It's nothing but the average performance will be taken. The average performance is calculated and set as a standard, where we can compare the actual with the standard. So standard is a norm where you are setting in by keeping the average performance into account. Then you are measuring the actual. What is the actual cost? At the end of the quarter, end of the month, end of the year, you will arrive to a actual cost, maybe related to wage, material, overheads, whatever it may be. So on one hand you have actual cost, on other hand you have standard cost. You are very clear about these two, actual cost and standard cost. Then you also have budgeted cost. What is budgeted cost? It's a kind of forecast. It is a kind of forecast how much you are going to incur on either material or labor or on overheads or any other kind of expenditure. So it's basically based on engineering methodology. It is engineered cost, that is called budgeted cost. You will have one more cost, namely marginal cost, that is additional cost incurred by producing additional units. Now the question arises is, when we talk about manufacturing cost, which cost we have to take? These are all costs. Actual cost is a cost, standard cost is a cost, budgeted cost is a cost, and marginal cost is a cost. So which one we have to take into account? That's very, very important. So that also must be taken into account while talking about the manufacturing cost. So what is more relevant, what is more appropriate must be taken as transfer pricing. That alone has to be taken as the basis for transfer pricing, because we are talking very clearly that the efficiency cannot be passed on to other unit. If you pass your inefficiency to other unit, automatically that also will be inefficient. So on the whole, the results will be either inefficient or ineffective. These are all some of the things we have to keep in mind. So again, further, if you want to go in depth, in deep, there are many things. So actual cost may be related to material, labor, overheads like fixed cost, variable cost. Okay, so it pertains to every aspect. Likewise, average cost, actual cost, standard cost, budgeted cost, and marginal cost. So depending upon the suitability, we may have to take as the basis for transfer pricing. That
Thank you
is
so
something
much,
about.
sir, Mishra sir and Swami sir, for getting us more deeper into the intricacies of manufactured cost. Swami sir, can we ask you to explain us about what is negotiated pricing?
Negotiated price, Professor Misraji already highlighted, already he spoke on the negotiated pricing. Now what happens is we have fixed the price of our product at a particular point, whatever the rate. We have taken a decision to sell it in the market. Normally, whenever we fix the price, it's very clear. You must know that what we are doing is we are taking the total cost. Probably you are aware of what is total cost. Total cost is nothing but prime cost, factory cost, office cost, selling and distribution cost, plus a percentage of profit. That is called selling price. So you are fixing the selling price of your product. When you put the price in the market, people may not be willing to buy at the rate you have quoted. Probably they may ask you to reduce. Then automatically what you do is, when people they are asking for a kind of reduction in the selling price. So what do? Immediately you look at the total profit that you are earning. Presume that you are earning 15% as a profit. What you can do is you can reduce to 10%. That is what you are bargaining. Okay, it is all right, I will reduce 5%. Still you are left with 10% profit. Further he may bargain for another 5%. You will be left with only 5%. If your sales are high, you are prepared to reduce further 5% and sell your product. So here what is happening, a kind of negotiation is taking place between the seller and the buyer. That is called negotiated pricing. So when the buyers are buying in bulk, automatically they resort for negotiation. We do compromise. We reduce the price and we sell at reduced price. That is called negotiated pricing.
Wonderful, sir. Mishra sir, can you briefly explain us the concepts of opportunity cost as transfer pricing?
See, when we talk of opportunity cost, what are those costs? Cost, if you don't do those things, if you don't do, what is that we are going to gain? For instance, we produce certain things, we have different kind of resources that we employ for producing something in our factory, and we incur a cost. Supposingly, if you do not do that and we obtain the products from elsewhere, how much we save? So opportunity cost is the cost of doing something in the company which otherwise we would not have incurred had we procured it from elsewhere or outsourced it. And in the case of transfer pricing, that becomes a very, very important question, whether we should do everything by ourselves or through all our divisions, or we can get those things from elsewhere, so that, as Swami was saying, the overall objective of the company of remaining competitive and also yet making profits can be achieved. So this opportunity cost is a very important concept. I'll request for Swami to, throw more light on that.
Yeah, definitely. When we talk about cost, there are two things. One, seller, other one, buyer. For seller, cost includes profit also. For buyer, cost is only expenditure. See the difference. In financial management, normally when we use the word cost, cost is nothing but the minimum rate of return to be earned over the investment. It's not cost. We are referring to the income to be earned over the investment. That is cost for us. That is cost for us. So, suppose I want to raise capital. If I raise capital through equity source, it is going to be costly to me. If I am going to raise the capital through debt, definitely it is going to be economical to me. In case had I raised the capital through equity source, definitely I am losing some income by not raising through debt source. So here what is happening? Our income generation is going to be affected. Had I procured the capital through debt source, definitely my income would have been increased. Since I have raised through equity source, my income has come down. This is called opportunity cost. So the revenue lost by not putting in other way in other project or by not raising through some other source, that is called opportunity cost. So theoretically we talk about the opportunity cost, is it not? Now you wanted to transfer, you wanted to fix the transfer price of your output, is it not? Is it practical to look at opportunity cost, calculate opportunity cost and implement opportunity cost? Though you are prepared to look at opportunity cost, but you are constrained by many other factors, since you cannot go to opportunity cost. But opportunity cost can be taken as a basis for fixing the transfer price.
Okay, sir. So we have understood that opportunity cost is one of the ways in which we can apply for transfer pricing, sir. Swami sir, we would like to ask you, how would be the impact of decentralization on performance evaluation?
Definitely, you are all aware, once we had centralized system of management, slowly what we have done, we talked about decentralization. What is centralization? In the case of centralization, the decisions are being taken at the central level only, at the top level only. So the decisions were taken at one level and the execution was taking place at different levels. It was centralization. Okay, there are many difficulties in centralization, hence slowly we have adopted decentralization. So the decisions will be taken at the place where the action takes place. That is about decentralization. Now we are in the era of multinationalism now. So we have large companies, especially after the company form of organization, after the creation of multinational companies, the size of organizations have gone beyond our imagination. Controlling has become very crucial for any management. So what we are doing nowadays is we are resorting for a kind of management control systems, in the sense, as in the very beginning I made it clear that the total organization will be divided into a smallest unit. Probably it could be based on the product, based on the service, based on geographical regions, based on any other criteria. It is going to be divided into a smallest unit, and definitely we are preparing the guidelines, how to report, how to measure the performance, everything we are making very clear. Now at the end we are delegating the power to the person concerned. Whatever amount of power, authority is required, we are delegating. He is free to exercise his power. He can further delegate to his own subordinates, but still he is made accountable to the top management. At the end, whatever, whether it is positive performance or negative performance, he is answerable or he is accountable. He will be held responsible. So it provides a kind of platform either to reward or punish the unit manager. So on the whole, the very idea is the process of decentralization will affect the individual unit a lot. Once the individual performance is improved, automatically the overall performance of the organization is increased.
Absolutely, sir. That was a very well answered part from your side, sir. Mishra, sir, could we ask you, do you recommend for effective transfer pricing with your vast experience?
No, I think one point that Professor Swami raised is the most important point. At least in the days of globalization, tax. Now, what is happening is that companies are abroad and they use transfer pricing method to evade taxes. What they do is that things they produce, they put them at higher prices, so that in some other country when there is a production unit that shows things received at higher prices, ultimately there is a very thin margin of profit, and they are then they pay very small money on that tax. And there are the problems. Now you've seen Vodafone, number of problems are coming in our country. Professor Swami, I think, again raised a very, very important issue that these things are getting standardized. For instance, now in the accounting standards, if I'm right, you have some AS accounting standard which deals only with transfer pricing. So with more and more globalization, you'll find that firms they don't get established only in one country. There may be head office somewhere, production unit somewhere, service unit somewhere, and they become real global firm in true sense of the term. And with that, I think more and more decentralization is required. As Professor Swami told, greater decentralization means more autonomy. More autonomy means you are taking correct decisions. As he told, you are very closer to the point of action. At the same time, you also have the motivation to do things better. With all that, I think what you can expect is that this transfer pricing system ultimately may help the firms in maximizing profits, may help the consumers in getting products and services at the cheapest, cheaper rates, and at the same time, I think will also help in sustaining the world economy, because we'll not then fritter away the world resources which are very, very scarce. And hence, I think it's a very important topic for discussion today.
Absolutely, sir. So you have, at the end of it, rightly put about the problems related to transfer pricing, especially in the context of globalization and the advent of multinationals, in such a huge way in every country, especially in India after liberalization. So, friends, we have come to the end of the discussions. And I think that now we are not novice to the concept of transfer pricing because we have learned the ins and outs of it. In fact, now just like tasty food is a feast to the stomach, similarly, the right kind of information, relevant information, is a feast to the mind for every intellectual. And I believe that every student is a potential intellectual. So I hope that you must have enriched your knowledge through these discussions, which were truly value additive. And on your behalf, I take it as my privilege to, as a God's grace, to thank our eminent professors who have enlightened our knowledge in this area. Thank you so much, sir.
Thank you so much. Thanks a lot.